Good afternoon, everybody. I guess it is afternoon. That was a tough act to follow. My wife says I have 2 left feet, so I'm certainly not going to start dancing on the stage. That would embarrass all of us, I think, and that's probably not a good thing. Firstly, thank you to the organizers for having us here today, and thank you for coming to our panel and listening to what we have to say. My name's David Smith. I'm with Capital Dynamics. I've been with the firm since late 2006. We're a private asset manager. We focus on private equity, private debt, and infrastructure with about $16 billion US dollars under management in funds and direct investments in infrastructure and private debt and private equity. That's enough about me. I think I'm just going to let the fellow panelists here introduce themselves. Christian Diller first, former colleague, Christian as well. Christian?
Yes, my name is Christian Diller from Montana Capital Partners. We are a secondary firm from Switzerland, but very active here in the region. We are very much focusing on the smaller end of the secondary market, where we are very happy to do also more complex transactions, which means we are investing in funds, but we would also buy single funds, single company stakes and co-investments or participate in GP-led transactions. And as mentioned, we've done here already in the region basically a few deals buying from family offices, from regional institutions, but also having investors here in the region.
Hi everyone, my name is Zidi Liu. I'm the founding partner of Green Harbor Investment. So Green Harbor Investment is a mid-cap private equity firm focused on the consumer sectors in Greater China. And so far, most of our portfolios are covering traditional consumer retail, consumer internet, education, and modern services sectors in China, which are all the most fast-growing sectors in China right now.
Hello, مساء الخير. This is Thamer Saeed. I'm the Chief Investment Officer of Mubadala Investment. It's a family office. It's a family office investment, and also I can say it's a multi-asset investment firm where we do private equity, capital markets, and other type of investments.
Thanks, Thamer. So what I was pleased about when I was asked to moderate this panel was that we ended up with a group of professionals who come from various, I think, important facets of private asset management. We have Thamer as a family office. We have Zidi, a founder of a general partner, investing in portfolio companies, albeit with a regional slant. And then we have Christian, who is an expert in the secondary market, an increasing part of the private asset manager's armory in terms of managing liquidity. So we took the title of the panel, and we thought that what we would do is look at private fund investment as an access vehicle for other private capital investment strategies. That was the way we interpreted the subject here. And we would include in that interpretation the activity that we see both in the secondary markets in private assets, whether you're a limited partner investor like Thamer or a general partner like Zidi, or indeed an actor in the secondary market like Christian. So that brings those various facets together. And we thought also we would speak about differences between the regions where we're active. Thamer obviously active in the GCC, Zidi active in China, including Hong Kong, and then Christian and I more broadly from a global perspective. So as we prepared as a panel earlier, we thought that one way to start would be to look at how we would each characterize the current state of private asset management in the areas where we focus. And for most of us, and I'm sure it's not too different from many of you in this room, one of the things that we're wrestling with as asset managers is valuation. We've had a very high valuation environment. Can I just ask those in the room, would you put up your hand if you're a limited partner or a family office style investor? And thank you very much. And perhaps those of you who are more on the general partner side as well. I'm just keen to see the balance we have in the room. Would you be good enough to raise your hand? Thank you so much. That gives us some good feedback. Very good. So in terms of valuation, The one word that I use at the moment is discernment. I think it's really important for us as asset managers, as stewards of your capital, protecting your capital if you're a family office or an institutional investor. It's important that we do that job well. And one thing that we learned as a panel as we were sort of preparing was that there are radically different views of what that high valuation environment means. So Thamer, maybe starting with you, because you had an interesting perspective on that.
When it comes to valuation, I think no one agrees on one number, right? It's very difficult to reach an agreement, especially with either with investments or the business owners. But here in the region, in the past 3 years, I think all you know, there were a structure of the economy, and this caused a slowdown, which helped us to value an investment that we are looking for, or we are actually entered on is in 4 to 6 multiples when it comes to EBITDA, and also 2 to 3 times or less when it comes to the top lines. When we discussed before we come here, the numbers was shocked or like a surprise for you, but let's say thanks to the one-time causes that happened in the last 3 times, give us an opportunity to do an investment in valuation lower than other side of the world or any other side of the world.
Zidi, your perspective on that?
I think everybody, I mean, when acting as a GP, what we really think about every day is just to not overpaying for assets. So we're just really paying for the assets' fundamental value. However, the valuation in the market that's being asked by the underlying assets is as a result of the supply and demand situation. So when the demand for such kind of assets obviously is very strong, and then the valuation tends to go hefty. And then the way of a general partner like Green Harbor is just also always looking for the sort of underpriced assets, which is not really the most hot assets that's being chased after in the market right now. And normally we do look at the fundamental of the growth of the assets in the next 3 to 5 years. And then because we're always going after the profitable and then assets with strong cash flows, so we're able to price it normally at the PEG, a PAC ratio of one times-ish. For the sectors we are currently looking at in China, such as like education, consumer internet, and under that there's like entertainment and there's like fintech. The growth aspects in the next 3 to 5 years is 15 to 20% under each subsector. So therefore, I think when priced on the PE level, we normally price in the range of 15 to 20x. For the more traditional ones, like consumer retail, the overall sector has been growing at 10%-ish. But if we're looking at the clear industry leaders under these subsectors, they tend to grow a little bit faster, and then we normally will still price on the EBITDA level of 8 to 10 times.
And Christian, your perspective, maybe both in terms of conventional profitability-driven valuation metrics, and also given the particular area where you focus, perhaps discounts or premia to stated NAV, including any roll-forward effects that you would generally employ in your secondary activity.
Yeah, so I think the very positive thing about being a secondary player is, and being globally active, that we see an entire spectrum of basically different funds and also companies there, and you get a very good feeling of the underlying valuations of these companies. And our portfolio is maybe like 45% Europe and 45% US and a little bit of Asia and Middle East. So I think when we look at the different valuation metrics, as you said, you see differences, and I think the US is currently very much leading in terms of EBITDA multiples. I think there you certainly see more numbers which are similar to what you mentioned before. I think especially companies that are growing a lot, you see multiples between 15 and 20 times. And then also in the healthcare area, the more stable businesses, you see these multiples. But you see then for smaller companies, maybe not so well diversified in their business models, multiples between 10 and 15. I would say in Europe, you see generally a little bit lower multiples, but I think also in general a little bit lower growth in the underlying portfolio companies. So I would say there you see different valuation multiples in the company, which is at least between the US and Europe, also reflected in the growth of the underlying portfolio companies. Then maybe back to your question on the secondary market now, when we buying basically fund stakes and what is the valuation between NAV, discounts and so on. And I think also for the secondary market there, you see that prices are certainly, depending on what I said before, how are the underlying valuations. We are looking at each underlying portfolio company, how the valuation is. So in general, you can't say that basically here one market is better or higher than the other. I think in general it's a market where you have good competition. Prices overall in large auctions are basically around 5 to 10% discount. I think that's what you still see. Some funds which are not too aggressive on valuations are traded around par or even premium, and the same is true for some brand names. But I think at the end, as you also said before, David, it's about looking at each individual fund, each individual asset to find out the right price.
So if I were to, thanks Christian, if I were to draw a few strands together, the thing that we were quite intrigued by as a panel as we prepared earlier was that, yes, high is a relative term, but it means radically different things depending on the markets in which you're active. Thamer here in the GCC countries, I think primarily in the kingdom, but also outside. Is that right, Thamer?
Says that kind again?
Your activity is primarily in the GCC.
Our activity is primarily in the regions,
Yeah.
Saudi especially, and the GCC, of course.
Yeah.
We have seen a lot of, we assessed in the last 3 years like 200 opportunities. We end up with 14 of them. So yeah, our focus is in the region.
Right.
Yeah.
So I think what I wanted to leave with you was high. Yes, it's a relative term. We all heard that probably many times over our careers, but the regional differences are significant. Christian, as I sort of take what you were saying on the secondary market, would you just comment on the use of leverage in the secondary market at the fund level rather than at the underlying asset level? Because we're seeing that, I think, as a more regular feature of secondary market investing.
Yes, exactly. I would say on the secondary market, you have in the meantime also different players. I would say even different categories of players. But you are right, in general, I would say the use of leverage on the fund level is basically higher over the last years. But I would also say there is a trend in the market that especially some of the larger players are using more leverage. I think that's well known in the market that some of the multi-billion funds are using excessively leverage, because if someone like a larger sovereign wealth fund is selling a portfolio of a few hundred millions, it's very diversified. They put leverage on this because also the competition is very high, and in order to get a basically nice return to investors, I think very often leverage is put on these transactions. I think on the smaller end of the market, where we are also active, we are much more cautious on the leverage side. I would say you can say this in general for all the smaller players here, that I think out of our perspective, we want to be more cautious. We want to be also more concentrated on the portfolio construction side and not basically only create like diversified indices. I think our approach is more looking at the assets, at the underlying performance of the funds and companies, and not putting so much leverage on the portfolio.
Thanks. Thamer, coming to you in your role as a family office investor, and managing a portfolio of assets in different sectors, perhaps also in different countries within the GCC region, would you consider a secondary market transaction as a positive in terms of restructuring or regulating exposures within your portfolio?
Yeah,
is it something you would look at?
Yeah, of course. And in our case as a family office, if I may say, we need sometimes to restructure the portfolio, to restructure the allocation of our position or the company portfolio. Secondary market is a very helpful tool to do that when it comes to either to have liquidity or to just switch the positions when it's come to focus between different sectors. That helps a lot, of course.
Okay. And then Zidi, from your perspective as a general partner, I think your funds are a little younger than perhaps some of the ones that we're used to. But if you had a limited partner who wanted to trade a stake, how would you look at that in terms of interacting with a secondary market actor?
I think normally when it encounters to restructuring on the LP side, there's normally two reasons. Number one is that we sometimes structure deal over a few level of SPVs, so that it's easier for each layer of investor to exit when they need the timing, when the timing is right for them. When sometimes GP holds different expectations of the growth of the underlying assets in the next few years. So for example, if we think this company is going to successfully IPO in the next 3 years and make a great return, but certain LPs really think there's a great trade sale opportunities, then what we do is just to facilitate the selling of their stakes through a certain level of SPV. So that's why normally we do set up like 2 to 3 layers of SPVs in between, so that it's easier for them to reach liquidity. And another situation will be LPs restructuring the allocation of assets, like you just mentioned, and then we'll definitely cooperate with them, and then to find the right LPs to come in. And normally it will be driven by the GPs, but sometimes LPs will just also facilitate the process on their side, and then we do cooperate.
And staying with you, if you had a limited partner in your fund who was thinking of trading his or her stake, would you prefer that stake be taken by one of your existing investors by way of a sort of a preemption or right of first refusal mechanism on the one hand, or on the other, would you prefer perhaps to engage with a secondary fund and bring a new investor to your fund? How would you look at that?
Yeah, we'll definitely first bring the allocation to our existing remaining LPs first, and because that's according to what's in the agreement. And then, but in reality, our existing LPs will take maybe like 50% of the stake, and the rest, the remaining, will be a good chance for us to draw in the new LPs, because when the new LPs come in, they will have like a dividend in the very near term, and that's also very attractive to them. I think this is also a good opportunity to build relationships and build trust with the new round of LPs.
Mm-hmm. So a bridge to an investor in a succeeding fund, perhaps.
Yeah, exactly.
Yeah, interesting. So we've spoken, thus far about what I would call the traditional secondary market, the traditional purchase or sale of a limited partner interest in a fund, an LP secondary. Over the last 5 years or so, the secondary market has been one which has innovated a very great deal. Some would say one of the most innovative parts of the private equity spectrum. We've seen things like direct secondaries, so a secondary in an existing portfolio company rather than a fund. We're seeing a whole slew of what so-called GP-led restructurings where general partners are facing the end of the term of their funds. They have limited partners with different goals, different perspectives about liquidity versus continuing. And then I'll just pick up that word continuing. We're also seeing things called continuation funds where maybe a couple of assets in a large fund are still able to grow, but they're running up against the end of the term of the typical fixed-term limited partnership that we see in private equity. Having set that up, I'm going to hand it to Christian because he really sits at the very nexus of those things. Christian, could you just comment on how the market is becoming more sophisticated in addressing those types of transaction?
Yes, absolutely. Very happy to do that. And when we look at some of the statistics that some of the larger intermediaries just published, they are saying that if you look at the trading this year, which on the secondary market is again one of the highest volumes ever. I think we might reach even trading volumes of 100 billion. And the GP-led transactions seem to be around 1/3 of this market, so around 30 to 35 billion, which is traded in these kind of GP-led transactions. And you can see basically, or to name some, so there were some GP-led from Nordic Capital, a large European player, or Warburg Pincus was active. There was also a very large transaction here in the region because Investcorp did a GP-led transaction together with some secondary player where we were also one part of them. And the idea there is, as David said, to provide liquidity to existing investors. And this could be in the case that basically the GP works together there with a secondary player and ask their existing LPs if they either want to go out of their LP stake, then it's called like a tender offer, or do a GP restructuring where basically some assets are sold from the existing portfolio to a new SPV and the secondary player comes into this SPV. Very often there's also a stable transaction involved, so you put also some additional new capital into that. But as you said, David, I think this market is getting very innovative. You see this also for just single asset continuation funds. As said, I think also in this market we are active on all kind of these levels like GP restructuring, tender offers, continuation funds. And the market is very active and offers basically their very attractive return potential. And you can add basically here as a secondary player some concentrated additional well-run companies typically.
Thamer, I think when we were preparing earlier, you mentioned that sort of transaction was just starting to be seen in the GCC.
Yeah.
Do you regard it as a positive or a negative, perhaps?
I think it's a positive.
And why do you say that?
Yeah, because our experience and our history with such a kind of deals is just new, and we need to have full of all tools in our hands to do our investment or do our deals with in this era of private equity and either to GBLB or secondary market. As it's new, and I think that it's a good entry level for the international player to come to the region to see what we have here, as we were very active in the past 3 years. We've seen what is there and what is the opportunity that we have. Having the secondary, having the whole option in our investment or investors' hands will help to enhance the market itself. So
that's interesting. So, from where I come, I would characterize what you said as an opportunity to get your feet wet, as it were, with an existing portfolio, and also perhaps build on a relationship with a particular manager. Is that how you would see it?
Exactly, yes.
Interesting.
Yeah.
Okay. Just before we go into questions, and I would encourage you in a few moments, if you do have questions, to raise your hand, but I just wanted to touch on the confluence between the direct secondary market, so rather than buying an LP stake in a fund, ultimately going one level below the fund and taking the interest in the underlying portfolio company. That's also become a very much more active area in the last 3 or 4 years. Maybe Christian and Zidi. Zidi first, are you seeing that in your portfolio, people transacting or wanting to be interested in direct secondary transactions?
I think the appetite from what we observe in China right now is liquidity, is cash exits. And for any fund, especially for fund with shorter tenure, that hasn't been really a problem because, like, for example, ourselves, like our DPI for US dollar fund 1 and 2 will reach like 1.5x by the end of this year, and then we'll fully exit all portfolio companies basically by the end of next year. So that hasn't really been something that's happening with our fund, but I have been facilitating some of the LP stake transacting for my friend's portfolio, and that's mainly because I think the LP circle in China is being gradually formed. Because like if you see in the US, most of the LPs are pension fund or endowments, but in China, I think it's mainly one big portion of the capital comes from the government and then from the banks, and then there will be fund of funds, and there will be large institutional corporates, and then obviously the capital that's coming from the larger cap institutions are a lot more stable, but when it comes to corporate, and then they will have sometimes rebalance their construction of their wealth, and then they will the liquidity needs will come into market from time to time, but oftentimes these people are savvy enough to invest in funds that have strong dividend capability. So it's really there's always a strong appetite to buy their stake, and then I haven't really observed any problems of exiting through these methods.
Christian, your perspective on the direct secondary market?
I think also this is an increasing market right now. I think there are more players active on the direct secondary side. More portfolios are also traded and seen in our deal flow. So I would say it's one element of the secondary market which is very active. It provides liquidity to investors. For secondary players, it's also very interesting because, again, you can focus on a few companies. You can put concentration into your portfolio, which I think as a secondary player is very good to get also additional upside and additional return.
So another arrow in your quiver as
Yes.
an investor, perhaps. Okay, that's really what we wanted to cover as a panel. We've got actually a nice small group here, so in the last sort of 3 or 4 minutes, I would encourage you to ask questions. We've got a terrifically experienced panel to my left, your right. Could I ask if you have any questions? If you would raise your hand, and we'll deal with them as best we can. One over there on my right. We have a microphone, I think. Would you let us know who you're with, so we can just have a feel for your affiliation?
I'm Simon Tandy. I run a family office in Dubai. My question to the panel is, what do you find the differing skill sets in managing a secondary fund as opposed to a primary?
I'll let Christian start with that. Thanks, Simon. And I'll comment at the end because it's a very good question, Simon. Thank you for asking it.
Yeah, so I would say on the secondary side, it's very important to be able to analyze the underlying assets and portfolio companies. So in our case, when we analyze one fund, we look at each portfolio company which is in this fund. We are looking at the business model of these companies, looking at revenues, EBITDA, development, but certainly also the net debt is more and more, especially in developed markets right now, one thing where we are focusing on because in some companies debt rates are very high. So I think there is a large focus of our analysis basically on the existing portfolio, on the underlying portfolio companies. How much upside do we expect out of these portfolio companies? What is the risk in the business model of these companies? Also in the sector and area and geography they are playing in. So I would say this is the larger portion of our analysis, what we are looking at. The fund manager then plays also a role, the track record of the fund manager, how stable they are, how good the team is. But while I would say on the secondary side, the assets maybe are 2/3 of the analysis, and the team and incentivation and everything around that is 1/3, I would say in the primary, the team is and the track record is just the very important thing. And maybe I hand over more for the primary side to you guys.
I agree.
Yes.
When it comes to assess an opportunity, it's the team behind the opportunity. Then it's what's the numbers behind analysis, what they say, and the reports behind that. And the secondary market is it's exactly what you have said. It's the opportunity itself. What's the future of it, and what's the potential upside on the opportunity itself?
Yeah,
Zidi, on the last, your perspective.
There's lots of carve-out opportunities from distressed groups, and just like the identifying of the good assets under a distressed situation. And number 2 is just to ask for a due diligence access and make sure we only get in when there's a strong diligence access to it.
I would just characterize it by saying primary fund investing, part of the title of this panel, is about manager selection. So when I say that, I mean general partner fund manager selection, whereas secondary investing, as Christian has very nicely described, is portfolio company management selection. Almost the same word, but actually a fundamentally different discipline. So Simon, thank you for raising that point. I think it also means that the type of person that looks at those two areas in an asset management firm is different. I'm afraid we're out of time unless the organizers allow one more question. Do we have time for one more? No, I'm afraid we don't. So rugby tackle me as I leave the podium. And thank you for listening, and thank you to our panelists for sharing their insights with us.